Hello there, David. Another strong start here. We started stronger. All 11 sectors were on the upside. A little mixed 5 minutes in, but tech was leading early on. Industrials, materials. Energy just turned negative. Remember, energy is the big laggard this month. That sector down about 6%. We're in the middle of earnings season. Not a lot of big companies today. I just want to note Charles Schwab did come in. They were basically in line, maybe a penny shy of estimates. A little bit unusual, but the key thing here, boy, they just keep raking in new accounts, 1.7 million. They have almost $4 trillion in assets under management now. Daily trading volume down 28%. Remember that big run up on the meme stock trading in January, February, March? They're down. Volume down 28% in the second quarter compared to the first quarter. Take a look at Schwab here. Remember, they topped out. Remember, Schwab is largely a bank. When rates started moving up, they moved up, topped out around February or so on the rates and all on the meme trading. So not a lot of surprise. Schwab's been a bit sideways since then. A lot of anxiety out there. We've been talking about it. David was talking about it. Mike was talking about it a little earlier about the markets because you've got dueling narratives. To explain why the yields are low, the first and obvious explanation is what Janet Yellen said yesterday. The market is saying inflation is transitory. The other narrative is sort of the pretzel logic narrative. Inflation is not transitory, folks. And what the low yields are saying is that the Fed is going to have to taper and sooner rather than later. They're going to have to raise rates sooner rather than later. And the market's reflecting the economic downturn down the road because we know the one thing that kills bull markets is the Fed raising rates. You might think, how could these two ideas even exist in the same debate? But actually they do. Part of the problem is there's a lot of anxiety out there because of the valuations in the market right now. They're very high. High valuations leave stocks vulnerable to a downturn. We know one thing for sure. We are likely at peak earnings growth. We've talked about this for a couple months. Peak earnings growth doesn't mean earnings are going to stop growing. It means the rate of change of earnings are going to stop accelerating. So that implies a lower multiple. That causes a little bit of anxiety as well with prices this high. So instead of 22 times forward earnings a few months ago, we're looking at 20 times forward earnings on the S&P 500 and maybe lower a bit as time goes on. You can't put a higher multiple after peak earnings growth. That's the source of a lot of the anxiety that's in the stock market. The other is these high valuations. If you look at the tech leaders, they are trading at multiples that are historically high. I'm talking about the big names, Apple, Microsoft, Amazon. You see these multiples? All of them are much higher than they were 2 years ago. I don't want to use last year. I'm going back to 2019 when most of these were in the low 20s and low 30s. So these are much, much higher here. And even with companies that continue to grow their earnings, these are topping multiples when you're talking about the peak earnings situation. If you were looking for the anxiety, yes, there's a little anxiety. The advanced decline line is not quite as strong as it used to be. But really, you're stretching to think that there is some kind of big decision on what's going on with the market. So far this month, you see the S&P's outperforming the equal weight S&P. Most of the time this year, the equal weight is outperformed, so a little bit of reversal. The Russell 2000 is the weak story here, and a lot of people keep saying this is some kind of bellwether. I quite do not understand this argument, folks. Look at the Russell 2000. It has been sideways since February. It moved up in the big run up earlier in the year and essentially has not been much of a market leader ever since then. David, the key to understanding this whole thing is that there's a lot more than an economic debate about the Fed's role in stimulating the economy and creating inflation. There is people who have been at war with the Fed and with the government since Roosevelt took us off the gold standard in 1933. These are the people who argue inflation is going to get out of control, and they're having a moment for the first time in 50 years. David, back to you.
Shepard Smith here. Thanks for watching CNBC on YouTube.